Assalamualaikum. Welcome to lecture 23 of ATX. This is a new lecture starting with a new tax, that is VAT. So till my lecture 22, the previous lecture was on company that focuses on corporation tax. Now we are moving on to a new type of tax. So lecture 23 and lecture 24 will be focusing on VAT. In this, we are going to focus on the basic, most of the things covered in your tax. Okay, so the outline of VAT. Now, so we are going to revise the basic VAT once again. Special accounting schemes, the three special accounting schemes we are going to go through. Land and buildings, this part is new in ATX. Partial exemption, again it's new in ATX. Capital goods scheme, and summarize the lecture. So now we are going to revise. The new areas are land and buildings, partial exemption, and capital goods scheme. These are the three new areas. Now, the scope and the nature of VAT. So what is VAT? VAT is an indirect tax. Remember all the tax till now that we were covering. Income tax, capital gain tax, inheritance tax, corporation tax are all direct tax except VAT. VAT is an indirect tax, and this is on consumer spending. It is charged on most goods and services in UK, supplied within the UK. It is suffered by the final consumer, and it is collected by businesses on behalf of HMRC. VAT is only charged by taxable person when they make taxable supply. VAT is not generally charged on non-business transactions. Okay, so we can quickly go through this revision. This is all your basic knowledge from your tax. Nothing new. Next, who is a taxable person? The person who is registered for VAT because they make taxable supplies. It could be an individual, it could be a partnership, it could be a legal person like a company. Okay, so a person for VAT, a taxable person for VAT could be a company, an individual, or a partnership. Now, taxable supply. Taxable supply is any supply which is not exempt or not outside the scope of VAT. Okay, so now for VAT to apply, you have to make a taxable supply. Okay, taxable supply by a taxable person. Now, input and output VAT. You should know what is an input and output VAT. Input VAT is those VAT that is charged on the purchases and the imports of the goods. When you are buying a good, when you are importing a good, VAT charged on that, that is input VAT. You have to pay it. You have to pay it. Input VAT, you can reclaim whatever the VAT you have paid while purchasing the good or service. You can now reclaim from HMRC. It is reclaimable. Now, registered business charge output. You can charge output VAT. What is output VAT? Output VAT is a VAT that you charge on the supply of goods and services to your customer. Okay, you are receiving this VAT from your customer. Input VAT you have to pay for purchase. Output VAT for the sale of goods you are putting it, right? You're charging it. This includes gift of good. If you're gifting a good also, VAT will be there. But not gift of services. It also includes imports. So imports is also there. Now, output VAT is payable to HMRC. You have to pay this. So remember, you are collecting VAT on behalf of HMRC. So businesses, they have to get this output VAT from their customer and give it to HMRC. Every month or quarter. It could be monthly or it could be quarterly. This input output VAT is netted off. Output VAT minus input VAT. Once it is net off, either you are going to pay to HMRC or you are going to reclaim from HMRC. Depending on your output VAT is more or input VAT is more. If it's input VAT is more, okay, you are going to get it recovered from HMRC. If your output VAT is more, you have to pay to HMRC, the difference. Okay, now, so all these are very easy. Now, how VAT works. Remember, VAT is collected by businesses at each stage in the production and the distribution process of goods and services. Businesses account to HMRC for the tax known as output VAT on sales. If the customer is registered for VAT and uses the goods and services for business purpose, they can recover the tax that they have paid on the purchase. But they have to be registered for VAT to reclaim that. If you are not registered for VAT, if your customer is not registered for VAT, you can't recover the tax from HMRC, remember, which is known as input VAT. Accordingly, business actually account to HMRC for the tax on the value added to the product at that stage of process. So businesses are merely acting as collectors of VAT on behalf of HMRC. Therefore, businesses do not suffer any tax. It is the final consumer who cannot recover the input VAT that they suffer. Okay, they cannot recover the input VAT that suffers the tax. Now, illustration of how VAT works. VAT is the standard rate, the standard VAT in UK is 20%. So as you can see this diagram, you can see there is a manufacturer, he charges to wholesaler, wholesaler charges to retailer, retailer charges to individual, that's you. So the manufacturer is charging 200 plus VAT here. Then wholesalers further charging another 80. You see, from 200 to 280, and then final price is even more. So what is he doing? And this is the output VAT. So this output VAT becomes the input VAT for the next one. This output VAT becomes the input VAT for the next one in the series. Okay, so if you add up the whole, how much they have to pay HMRC? If you add all this, it adds up to 63. Okay, so he's bearing the 63, the price that 315 plus VAT, 350 plus 63, this 63 VAT is suffered by you, the final consumer. Okay, so your price, your final price will be 378 because with 350 there's a VAT of 63 with it. This 63 is suffered by you, the final consumer. Okay, you don't have to illustrate this process or you don't have to draw it, it is just for understanding. Now, there are various types of supply. You have to categorize the types of supply. One is exempt supply, the other one is taxable supply. Exempt supply, by the word itself, you know, exempt from VAT. So it includes insurance, financial services, postal services, land, including the rents, but you have to see later. There are some rules for land. These are exempt from VAT. So traders making exempt supplies only cannot register for VAT and cannot reclaim input tax. See, because they are exempt, they cannot even reclaim the input tax. Neither they can register for VAT because they are exempt, neither they can reclaim the input tax. Now coming to taxable. Taxable, there are two types, zero rated and standard rated. Zero rated means 0%. They are not exempt, but they are zero. There's a difference between exempt and zero rated. I will tell you later. First, let's go through the items. Non-luxury food, books and newspaper, public transport. Remember, public transport, not taxes. Children's clothing, medicines, exports. These are zero rated. Difference between exempt and zero rated is, if you are zero rated, you can reclaim the input tax. Why? You are registered for VAT. It is 0%, yes, but you can reclaim the input tax. That is the advantage. Exempt means you can't reclaim the input tax. And standard rated is everything else other than that which is exempt and zero rated is at 20%. VAT is charged at 20%, everything else other than this list. Now, there's a reduced rate of 5%, we'll see later. Okay, now, so you have to note some taxable supply, like some taxable supply are charged at reduced rate, but these are not important for your exam, so don't worry. Some supplies are outside the scope of VAT, like wages, shares, dividends, other taxes, road fund license, and sales between members of a VAT group. These are outside the scope of VAT, so forget about it. Now, mixed supplies. This is a mixed supply. Mixed supply means is where there are individual elements within the supply that are treated separately for VAT purpose. So you have to split these different elements. And you have to charge the VAT at appropriate rate on each element. An example of mixed supply would be fees charged to a football team that plays in a weekly league at a football stadium. So the team plays. Okay, remember the fee for the use of the stadium is exempt. Okay, but there's a separate fee to play in the league that is standard rated. So you see, there two are in one. It's a big supply. But the fee for the stadium is exempt. The separate fee to play in the league is standard rated, 20%. Now, that's why these two elements has to be treated as a separate supplies rather than a single standard rated supply. You can't take them together and apply 20%. No. Okay. Next, composite supplies. After mixed supply, we are compounding composite. Please do not confuse the two. The two are different from each other. Composite supply or single supply is where there is just one supply with a single rate of VAT. Even though that supply may be made up of lots of different things, each with different applicable rates of VAT. A good example is a flight with a meal. This is a composite supply. Okay, why? Air transport is zero rated, but the catering, the meal is a standard rated. But the customer is buying a complete package. They are not buying meal separately and flight separately, no. They are buying it as a complete package. Therefore, in this case, it's difficult to separate the two elements. In the earlier case, it's easy. Fees for the stadium, fees for the league. Here, it's difficult. That's why the meal, and if you see the meal part, even if it is standard rated, it's very small and insignificant part of the package. The bigger part is the air transport. So therefore, this air transport, the ticket that you are buying to fly will be classed as a single supply, and it will be what? Zero rated for VAT purpose. We look at the bigger portion, not the catering part. Next. So this follows the code of appeal decision in the BA case. Let's see some cases. So in this case, the court found that the supply of an airplane ticket with a complimentary food will be a single supply. So this conclusion was reached because airline provided a meal regardless of whether the customer wants it or not. Everyone is given the meal. So therefore, BA, British Airways, are not contractually obliged to provide the meal. Therefore, customers could decline the meal. Okay. Customers who decline the meal could not claim a refund. You can't get a refund. So based on this, they are saying it is zero rated. It's a single supply. Next, VAT registration. This is important. You should know what is the threshold, when you can register, when you have to deregister, the timing of VAT. So if a person is making a taxable supply that exceeds your registration threshold, registration is compulsory. Taxable supply means all standard rated, reduced and zero rated, but not exempt supply. Exempt supplies are not taxable supply. Remember, excluding VAT and excluding the sale of capital assets. If a trader makes zero rated, wholly zero rated supplies, that means completely zero rated supplies, VAT registration is not compulsory. Even if you have exceed the registration threshold, it's not compulsory. It's voluntary, your choice. But even if it's not compulsory, remember, voluntarily you might register. It's possible. And voluntary registration is useful also for you if you want to reclaim your input VAT. However, even if you register for VAT voluntarily, you have to take care, because then your selling price will increase to the public. You will include VAT also in your selling price. Now, VAT registration, voluntary and mandatory. So first we'll go through voluntary. So voluntary, possible if you are making or you are intending to make taxable supplies. Advantages: you can avoid penalties for late registration, recover input VAT. This will help you to disguise your size of business. Okay, if you voluntarily register, even if a small business, might look like you're a big business, right? It can bring you maybe more customer. Next, disadvantage. There's an administration burden to register for VAT, and if you're charging output VAT, your final price will be higher to your customer. Okay, so the price will be higher for the non-registered customer. Now, compulsory. For compulsory, there are two tests: historic test, future test. If you pass this test, you have to compulsorily register. Historic test. Historic test means you look in the past 12 months. Okay, or it could be shorter if you have just started a business. Let's say you have started a business for 7 months, so last 7 months you will see. So if your taxable supply exists 85,000 is the threshold, that is the registration threshold. So if you are exiting taxable supply in the last 12 months 85,000, you have to notify HMRC within 30 days. Remember, these dates are very important when you have to register, notify HMRC. It might come as a part of ethics question. So within 30 days of the end of the month in which this threshold exists, registered with effect from first day of the second month after the taxable supply exists the threshold. We'll definitely do questions so that you understand these dates. Next, future test. You will see if you have not passed the historic test, you will see in the future. That means in the next 30 days, is your taxable supply likely to exit the 85,000? If it is likely to exit 85,000, again notify HMRC. The date is different here. Before end of 30-day period. And registration is effective from start of 30-day period. That means 1 month. Next, you have to note that while registering for VAT, registered traders are required to account for VAT. If the business fails to register in time, there is a penalty for it. A person registered for VAT could be an individual, partnership or company. Okay, that person could be an individual, that means sole trader, partnership or company. An individual sole trader has only one registration which covers all of the sole trader business that he covers. He might be having 5-6 businesses, one sole trader. All those 5-6 businesses will be covered under one registration. He does not have to register for all the 6 businesses separately. No, only one registration covers his entire businesses. Next, if it's a partnership, okay, even the partnership registration will cover all the businesses carried on by the same partners. Okay, but if they are operating any businesses as a sole trader, there's a different registration for that. That means a partner is operating, working under partnership also, having a separate business also. The separate business will not be covered under the partnership registration. This you have to remember. Next, companies. Companies are registered individually. Although it is possible to have group registration, we'll see later group registration also. Now, it's possible you can register, deregister, make variations to registration online. But it is not compulsory that you have to use online service only. Now, VAT groups. So UK companies that are under common control can elect for a group VAT registration, provided all companies are trading in UK via a permanent establishment. This permanent establishment part I've covered in previous lecture. Okay, if you're a non-corporate entity, that means you're either a partnership or a sole trader, still you can join a VAT group. If it is the controller of a group of companies, that means you as a sole trader or a partnership is controlling a group of companies, you still can join the VAT group with the company. In order to join a VAT group, this is the condition. The controlling entity must carry on a trade in UK. What is the definition of common control? It is the same as the definition of associated companies. A company controlling another company, 2 or more companies controlled by same third person. Indirect control. If there is that means parent having a subsidiary and that subsidiary is having another subsidiary. So indirect means your indirect does not need to be greater than 50%. Okay. There just needs to be a greater than 50% interest at each link. Let's say parent is having subsidiary 1, subsidiary 1 is having subsidiary 2. So parent should have greater than 50% as subsidiary 1. Subsidiary 1 should have greater than 50% in subsidiary 2. Not necessarily parent should have greater than 50% in subsidiary 2. Okay, that's what it means. Now, the key difference is that individual is not accounted as an associate, but may be able to join a VAT group. Next, example of VAT groups. Company is controlled by same individual like this. So Mr. X is having Y and Z. Both Y and Z are controlled by Mr. X because they are having greater than 50%, 80 and 70. This is an example. So they can join a VAT group. Mr. X, Y and Z. Next, Y and Z are associates also. Okay, so X, Y, Z form a VAT group. Next, consequences of a VAT group. A VAT group is treated as if it was a single company for the purpose of VAT. Group registration is optional and not all members under the common control have to join. It's not compulsory. And what about overseas company? Overseas company with no UK permanent establishment cannot be a part of a group VAT registration. Transactions with such companies, if you are transacting with overseas company who has no UK permanent establishment, whatever the transactions you are doing with them will be treated as exports or imports. Now, next consequence. Goods and services supplied by one group company to another within the group registration is ignored for the purpose of VAT. Therefore, you don't have to account for the VAT on intra-group supplies. That's good. That's an advantage. Any transaction between intra-group, ignore for VAT. Next, there is one representative member if you are joining a VAT group. So VAT group appoints one company as a representative member. Then that representative member will be responsible for accounting all input and output for the entire group. Now, so the representative member submits one single VAT return which covers all the group members. But remember, all companies are jointly and severely liable for the group VAT payable. There is a normal time limit applies for submission of VAT returns for the VAT group, and an application of a group VAT registration has an immediate effect, although HMRC has 90 days during which it can refuse the application. Now, so advantages and disadvantages. Advantages: intra-group supply is eliminated, only one VAT return, that means administrative cost will be lower. It is flexible, not all group companies have to be involved. Companies which are making exempt supplies can be included in that group. If they are included, now they can recover the import tax. Now, next disadvantage. All members are jointly and severely liable for the VAT payable. So a single return, even though it is easy, it's difficult also. You have to collect information and collect everything. Next, so if you are including a company who is making wholly or zero rate of supply in the group, it could result in a loss of monthly repayment. If you are including an exempt company, okay, it can cause the group to become partially exempt. This may restrict the import tax recovery, which would otherwise you would have recovered. Now, the limits for joining the cash accounting scheme. I've told you there are 3 accounting schemes, okay, special schemes. Out of it, one is cash, which we are going to cover later. That's the next subtopic after this. So the limit for joining that are applied to the whole group rather than the individual companies. And the annual accounting and flat. So annual accounting and flat, another scheme. Okay, out of the 3, annual accounting is one, flat rate scheme is another one, and cash is another one. So these 3 are the schemes that we are going to cover later on. So annual accounting and flat rate schemes are not available to companies registered as a group. If you are registered as a group, this will not be available then to you. Pre-registration input VAT. Before you register the input VAT that you have suffered, what do you do with it? This also you can recover on the following. That is good if it's in inventory and non-current assets. If you have acquired for business purpose in the last 4 years and goods are still in the hand at the date of registration of VAT, you can reclaim that. Services, if supplied for business purpose in the 6 months before registration. If you've incurred any input VAT for that service, you can now recover after registering for VAT. Deregistration. Deregistration is compulsory when a business ceases to make taxable supply or is sold, although you can make joint election to transfer the registration to a new owner. Okay. Voluntary deregistration. You can voluntarily also deregister. That is also possible. Now, so deregistration compulsory, voluntary. If it's compulsory, when you cease to make taxable supply, you have to notify HMRC within 30 days and registration is cancelled from the date of cessation. Voluntary. If you are seeing an evidence, if there is an evidence that supplies in the next 12 months, if you can see that the supplies in the next 12 months are not likely to exceed 83,000, 83 not 85, 85 is for registration, for deregistration is 2,000 less, 83, then registration is cancelled from the date of request or agreed later date, whichever is later. Next, so now the final VAT charge on deregistration. Whether you are doing compulsory, whether you are doing voluntary, there's a final VAT charge on deregistration. So the output VAT must be accounted for on replacement value of inventory and capital assets on which input VAT was reclaimed on hand at the date of deregistration. Charge waived if VAT liability. If your VAT liability is less than or equal to 1,000, this charge is waived. That means it's taken off. It's withdrawn. Not levied if registration is transferred. If you are transferring the registration to a new owner rather than deregistration, then this final charge on deregistration is not levied. It's not charged on you. Remember, when you're deregistering, there is a final VAT that will be charged. Now, VAT on the sale of a business. When you're selling a business, you have to charge VAT on the sale proceed for taxable assets transferred. But if you are transferring as a going concern, this is avoided. This VAT is avoided. Okay. Next. So the conditions for transferring of going concern. You are transferring the business as a going concern. There is no significant break in trading. Same type of trade is carried on after the transfer. New owner is liable to the VAT registered immediately after the transfer. Okay. Now, not that all of these conditions must be made. All of this condition has to be made. Not just one. Input and output VAT. Note that output VAT is charged on the actual amount received from the customer if a prompt payment discount is offered. Remember, there is no distinction between capital and revenue expenditure for VAT. So input VAT is recoverable on the purchase of capital assets. For example, you are purchasing plant and machinery or van equipment, as well as revenue expenditure, except for irrecoverable items. Irrecoverable items is covered in the next slide. Okay, next, VAT accounting. So VAT accounting, output VAT, input VAT. Output VAT, normally based on the price charged by supplier. If a trade or a bulk buy discount is allowed, calculate VAT on the discounted amount. Why? Customer is going to pay the discount. You are going to reduce that trade discount from the price, and that customer is going to pay what price? The discounted price. That's why the discounted amount you have to pay VAT. Calculate VAT. If there's a prompt payment discount, what is prompt payment discount? Prompt payment discount means you are saying that you are going to give this discount if customer is paying early. Okay, that is known as prompt payment discount. You are giving a discount to pay early. So if prompt payment discount is offered, VAT is charged on the actual amount received from the customer. Here you can't say on the discounted amount. Why? Some customer might pay on the discounted amount, some customer might pay late and might not get the discount. That's why VAT will be charged on the actual amount customer receives from customer. Next, so if paid within the stated settlement period, VAT will be charged on discounted amount. If paid after the status settlement period, VAT will be charged on full amount. Output VAT is charged on replacement value of goods taken for own use by sole trader or partner in a partnership business. Replacement value of inventory or capital assets gifted unless total gift to same person are below 50 in cost in 12 months. Ignore the gift of trade samples and gift of services whether to an employee or customer. Ignore. Coming to input VAT. You cannot recover input VAT on following items. Business entertaining. You can't reclaim. But except when you are entertaining your staff and overseas customer, then you can reclaim. Cars. Input VAT on cars you can't reclaim unless that car you have used 100% for the business and you have purchased for immediate resale. Next, you cannot reclaim input on 50% of the car leasing charges where there is a private use of car. Motor expenses. So, input VAT is recoverable on all the car running costs even if private use of car. Fuel supplied for owner and employees. Okay, these are the motor expenses. Now, so the motor expenses, private fuel supplied by business. Businesses pays for all the fuel cost and they can recover all input VAT. But if there is some private use of the car, okay, let's say for that private use of car, driver reimburses for the full cost. Then output VAT is payable on the amount reimbursed, amount paid by driver. If driver does not pay at all, output VAT is charged. Output VAT is payable on a scale charge. So you have to see whether the driver is reimbursing for the full cost or not. If it's reimbursing, amount reimbursed, not reimbursing, on scale charge. Now, so this fuel scale charge is based on CO2 emission of the car. And if it's relevant, will be given to you in the exam. Do not worry about it. So the treatment of scale charge is this. The VAT scale charge will be added to your output in the VAT return and output VAT is borne by the business. Output VAT can be avoided. This output VAT can be avoided if no input VAT is recovered on the fuel or no private fuel is supplied at all. Now, relief for impairment losses. Normally, output tax is accounted for when an invoice is issued. If the debt becomes irrecoverable, what happens? Seller has paid VAT to HMRC and they never recover this amount from the customer. So this position will be addressed by whom? The seller being able to claim the VAT relief for the impairment loss. It's an impairment loss because now debt becomes irrecoverable. Customer is not paying you, but you have paid the VAT to HMRC. So now you can claim that VAT relief for impairment loss. But provided following conditions are satisfied. First condition, at least 6 months have to lapse between the payment, okay, since the payment from the customer was due or the date of supply later. The debt must have been written off in the seller's VAT account. Claim for the relief for irrecoverable debt must be made within 4 years and 6 months of the payment being due. Okay, so if this condition 6 months have lapsed, debt was written off in the seller's VAT account, you can reclaim the VAT that you have paid. Now, this relief, okay, how do you get this relief? It's added. Okay, so this relief is obtained by adding the VAT element of the irrecoverable debt to the input tax claimed. If there are a series of supplies, let's say 5-6 supplies are there, and any payments made by the customer must be allocated on a FIFO basis. So let's say customer is paying you. To the same customer you are paying 3 times, but in a 3 separate transactions. On 1st, on 15th and on 30th of November. So now customer is paying one by one. So when customers are paying, payments are allocated on a FIFO basis for the first supply first. Okay. Unless the customer allocated a payment to a particular supply, unless the customer says that this payment is for this supply and paid in full. Now, VAT records. You have to keep the VAT record. VAT Records must be kept for all goods and services received and supplied in the course of business. There is no particular form for it, but record should be sufficient to allow you to complete your VAT return and allow HMRC to check the return. Now, the record must be kept up to date and must be preserved for 6 years. Okay, so following the introduction of making tax digital, VAT registered businesses are required to keep their VAT records electronically. The details around making tax digital will not be asked in ATX exam. In practice, the main records that must be kept are this: copies of all VAT invoices issued, a record of all output, sales daybook, evidence supporting claims for the recovery of input VAT invoices, a record of all inputs, purchase daybook, and a VAT account. Now let us do a question. Test your understanding 1. So in test your understanding 1, you have 6 supplies and how you account for it is the question. Okay. So assuming today is 1st Feb 2023, Xiaomi has not yet registered for VAT. She wishes you to advise her when she will have to register compulsorily for VAT and whether it would be beneficial to register before that date. So you have been given A to F. Okay. Now, with that, you have been given some more information. So for the remaining part of the question, assuming that Xiaomi has registered for VAT and that she has been trading for few years. Okay. So there are another one, few more. First, we'll finish this one. Okay, under first one, we'll finish the 6 parts. Okay, first one. So we'll go to the later part. First, we'll finish with the first one, the A to F. Her sales revenue for her first year ending 31st December is estimated to be 114,000, occurring evenly over the year. All customers are VAT registered and all of Xiaomi's turnover is of taxable supply. So for A, if you see, just okay, so basically you have to read all and then decide. Okay, this is 114, which is exiting 85,000 if you see. Next, she purchased computer equipment for 3150 including VAT on 14 Jan 2023. Her business telephone bills are estimated to be 360 per quarter including VAT. She uses a room at her home as her office. Her house has 5 main rooms. Electricity bill 5,000 including VAT of 71. She uses a petrol engine car, uses 75% for business. Bought the car in October for 15,000 including VAT, valued at 13,500. Car exits this 140 emission. Actual running costs excluding petrol are 1,100, includes 180 of VAT. Charges all her petrol costs through the business, which accounts to 150 VAT inclusive per month. Now, prior to starting business, has paid her accountant 350 plus VAT on 1st December 2022 on drawing up cash flow projections. Her annual accountancy preparation costs are estimated to be 600 plus VAT. So looking at this amount, 114 turnover, taxable turnover, it says all are taxable. It exists 85,000. So they have to compulsorily register for VAT. On which date? Her sales revenue for the first year ending 31st December 2023. Okay, so now registration. We'll talk about registration. So in this case, she will be liable to compulsory registration for VAT. So here we'll see her turnover. her turnover is 9,500 per month starting on 1st of Jan 2023. So if you take that 9,500, when it is likely to exit? 85,000. After 9 months. That means at the end of September 2023 it will exit. So this 114,000 divide by 12, take it for months, take it monthly. If you take it monthly, okay, you have to take it monthly. This is for year they are giving. So it is 9,500 per month. Per month you have to check. Okay. So it's 9,500 per month. If you are taking it after 9 months, okay, here, this is the answer. So 9,500 into 9. It's 85,500. It's 85,500. It is exiting 85,000 after 9 months. That means end of September 2023. So from this date onwards, you need that month, because you have to notify HMRC when? 1 month, 1 day. Okay, that means second month following the end of the month on which taxable supply is exiting. Taxable supply is exiting end of September. 1 day after that, 30 days, 1 month. So she will notify HMRC by 30th October 2023, from 30th September to 30th October, and this will be registered with effect from the next date, that is 1st November, because after 30th November it is the next month, the second month they told, not 1 day, I'm sorry, it was exiting in September, 30th September. So the second month, the first day of the second month. So from September, October, November is the second month, and the 1st of November. That's how you decide the date. Okay, so will be registered with effect from 1st of November or an earlier agreed date, but let's assume 1st November. So now, first point, you have to decide whether they are exiting the registration threshold. You need the annual divided by 12 months, and monthly it's 9,500, and see in which month it is exiting 85. So at 9, then you take the dates. After that, you have to talk about advantages and disadvantages of registering voluntarily or not. So here she is selling to all are VAT registered trader. So therefore, if you are registered for VAT voluntarily, there is no disadvantage. So if you are registering for VAT voluntarily before 1st November 2023, there is no disadvantage, because all your customers are registered for VAT. So all the customers will be able to reclaim the VAT charged by Xiaomi. So no disadvantage. Okay. If the customers were not registered for VAT, then it would be a disadvantage, remember. So this depends on the question to question. Now, so what is the main advantage? See, the requirement told you she would like you to advise whether she have to register compulsorily for VAT or not. That you have done. Now you have to see whether it is beneficial to register before that date. Okay, two requirements are here. So you're answering both the parts. Always check whether you're answering all the parts of the requirement or not. So the main advantage of registering early is that Xiaomi can claim the input VAT as follows. So on this they can claim the input VAT. What is it? The next one, the computer equipment is there, business telephone is there, use of home as an office, car purchase, and we'll talk about the cash flow projections. First we'll go through the computer equipment. Okay, so let's go to the computer equipment. So you have purchased it on this date before registration for VAT, right? 14 Jan, and it is from 1st November for this. It's including VAT, by the way. 315. You have to take the VAT out. So here, even if purchased before registration, the VAT can be recovered provided they still own the computer at the date of registration. If at the date of registration they are owning the computer still, they can reclaim the VAT. How much will be the VAT? It is 315 because it includes the VAT. You have to take the VAT out. 20% is there in 120. This is how you take the VAT out. 20 divided by 120. So it's 525. That's how you get 16 because 20 divided by 120. This is maths. 2, 2, 1, 12 divided by 2, 6. 1 over 6. So 20 divided by 120 or 1 over 6 is the same fraction. You will still get this. Okay. So you have to reclaim. You have to find the VAT. VAT is included in that 3150. Now I have to take the VAT out. Okay. Don't do this. Many students do this. They take 20% of 3150. Remember, this you can only do if it was VAT exclusive. VAT was not there. If it's VAT inclusive, you have to. Mostly they will give you VAT inclusive only. So they can now reclaim 525. Coming to business telephone. Okay. So this is done. This is done. Business telephone is 360. This is also including VAT. 360 per quarter. So this also 360 into 160. That means 360 into 20 divided by 120. 60. You can reclaim 60 per quarter. You have to write. If it's per month, per month. Per quarter, annual, annual. You have to write it like that. Okay. Next, use of home as an office. So this is over. Now he's using, her house has 5 main rooms and she uses a room, 1 room out of the 5 as her office. And electricity bill is 1500 including VAT of 71. Already they have given you the VAT. So you don't have to find the VAT. Okay. 71. Already they have given it. But this 71 VAT, remember, is for the whole house. Only one house you are using as an office. 1 room you are using as an office. So that's why out of the 5, 1. That's why it's 1 divided by 5. Only for 1 room. So 14. They can, remember, you can only reclaim VAT on the business portion of the electricity bill, not for the entire home. So out of the 71 VAT, divide by 5 because only 1 room you are using for business. Next, car purchase. So this is over. Car purchase. For car purchase, you can't reclaim the VAT. This you should know by now. We have gone through the slides. So you cannot recover VAT on the car purchase. But you can recover VAT on the running expense. And she recovers input tax on petrol also. If she recovers input tax on petrol, she will have to account for VAT fuel charge due to the private element. So first we'll find the running expense. What is the running expense? They have given you the running expense. The charges all are petrol to the business 150 VAT inclusive per month. So this 150 also take the VAT out. 150 into 20 divided by 120. 183. Now, so we'll find out the input tax on petrol. We'll find the petrol part. So now, CO2 emission was 140. Scale charge is 331 per quarter. They have given you the scale charge. They have to give you. Okay. They have given you the, where is it? It's here. 183. Okay. 143 is CO2 emission. So now, if you take this 333 into 1 divided by 6, take the VAT 55. Okay. So the VAT scale charge is 331. You have to find the VAT, which is 55. This you have to add to the output tax for each quarter. Okay, but this fuel charge can be avoided if GME does not claim any VAT input tax in respect of fuel. If they do not, you can exclude this VAT charge. Next, the last one. So this is over. F. What about F? So there is 350 plus VAT and annual accountancy preparation cost is 600 plus VAT. What about that? So here he registers by 1st June 2023. So because she registers by this, she will be able to reclaim the input VAT on her accountant's fee. Therefore, she can recover the input VAT on services supplied in the 6 months before the registration, prior to registration. This is a service here you are giving. Drawing up a cash flow projection. So he is giving 350 plus VAT to the accountant to draw up a cash flow projection. It's a service. Okay. Now, second. So we are over with the first one. Let us go through 2, 3, 4 and 5. You have to assume the VAT will apply for the VAT. Now, so the VAT scale charge with a car 140 is 331 per quarter inclusive of VAT. So now the second one. This is about a debt. I'm assuming it's irrecoverable debt. So you have to advise GME on the VAT position on this debt. So in her second year, has problems collecting a debt from this. She invoiced the company 3,500 including VAT, which was due on 15 March. In September, received 1,000. But in October, she wrote off the rest of the debt as irrecoverable. So remembering the rules of irrecoverable debt. Okay. So this includes October. In the quarter which includes October, they could make a claim for her VAT on her outstanding debt. Out of 3,500, 1,000 is paid. It's gone. Now you're left with 2,500. This is irrecoverable. So this take the VAT out. VAT is 417. This you can recover. This is permitted. Why? Because GME has written off the entire debt and it is more than 6 months since the date payment was due. Okay, 6 months since the date the payment was due. Check the dates. Payment was on 15 March, due on 15 March. And in October you're writing it off. Okay. So more than 6 months went. Now, next, third one. In her third year, decided to offer a trade discount of 5%. Now you have to advise which action they should take for VAT purpose when invoicing customer. It's on a discounted amount. It's a trade discount. So 5%. So trade discount. And there is a VAT. 1,000 is the price, 95 and 20. So he will charge on this 190. VAT must be charged on the discounted amount. That means 95% of 1,000. On this you will charge 20%. So this 1,000 was excluding VAT. Okay, the VAT charge should be 190. Now how do you know it's 1,000? See, she received 1,000. This 1,000. Okay, we are talking on that. It is one after the other. Okay. Because you have received 1,000. Now Just a minute. Okay, so the fourth one. I'm sorry, it's not on this 1000. It's just they've not given the 1000 anywhere. This, they are giving you an example. They are saying for an invoice 1000 excluding VAT, this should be the way. That means on the discounted price you have to charge the VAT. You can give any example. Fourth, assuming that instead of offering a trade discount, they offered a discount for a prompt payment. Okay, discount is 5% if paid within 14 days and 2.5 if paid within 30 days. Now they paid after 21 days. That means they are going to get a discount of 2.5%. Okay, so for the fourth one, they are going to get this discount 2.5. Same, let's take an invoice of 1000. Same example, 20 on this and this. So this will be your VAT. Why 97.5? Because they're taking 2.5 discount. The last one, in the fourth year, this is an offer for a business of 450. Now, whether VAT needs to be charged on this amount and whether there are any other action that she should take, the projected sale date for the business is 31st May 2027. Now, so this is a sale of a business now. There are two issues you have to consider. First issue, no VAT if they sell her business as a going concern. Okay, that means the new owner is liable and becomes a VAT registered now. Assets sold are used in the same trade after the transfer and no significant break in trading. That means it is as a going concern. So if these conditions apply, there will be no VAT. Next thing, if they sell the business and it's not as a transfer or going concern, you have to deregister. Okay. Next, you have to notify HMRC within 30 days of cessation. Next, you have to account for the VAT on the replacement value of the inventory and tangible non-current asset at the date of deregistration. But if the VAT is below 1000, you don't have to pay any VAT. Next, special accounting schemes. There are 3 special VAT accounting schemes that could be asked, and it was covered in tax, namely cash accounting, annual accounting, and flat rate. Starting with cash accounting. So under this, VAT is accounted on the basis of amount received and paid in the VAT period. To be eligible for cash accounting, you have to meet following conditions. Number 1, trader must be up to date with VAT returns and must have committed no VAT offense in the previous 12 months. Taxable turnover including zero rated supply but excluding VAT and excluding sales of capital assets must not exceed 1,350,000 per annum. Remember, if it exceeds 1.35 million, you will fall under the other scheme, not cash accounting. It should be less than 1.35 million. Because if it's more, it's very difficult to handle cash, right? Next condition. The trader must leave the scheme. You have to leave the scheme once your taxable turnover, excluding VAT in the previous 12 months, exceeds 1.6 million. Or it is expected to exceed this level in the following 12 months. Either in the previous 12 months it has exceeded, or you are expecting it to exit in the next 12 months. 1.6 million. You leave the scheme. The limits for joining and leaving the cash accounting scheme are based on a group figure, where a VAT group is present. If it's a VAT group, you have to see the group figure, not individual figure. Remember, this was one of the disadvantage of VAT group while we were going through that table, that one. Next condition. Cash accounting scheme cannot be used for goods that are invoiced more than 6 months in advance of the payment date or when an invoice is issued prior to the supply actually taking place. You can't use cash accounting scheme. Main advantages. Remember, know the advantages and disadvantages of all the three schemes. This will help you to write. Okay. Next, where customers are slow payers, there are irrecoverable debts. So no VAT is payable until you have received the money. That's good. Therefore, automatically you are going to get a relief for irrecoverable debt. There will be no irrecoverable debt. Because if there is irrecoverable debt, you don't have to pay VAT until your customer does not pay you. Next advantage. Information for VAT return can be taken from the cash book. Therefore, there is no detailed cut-off procedures required. Third disadvantage. Disadvantage is the delay in recoverability of input VAT, which cannot be claimed until purchase invoices are paid. Annual accounting scheme, the next scheme. So this scheme alleviates the burden of administration of VAT and helps the cash flow of the business. It's a burdensome, right? To keep an administration of VAT, to check on the cash accounting scheme, to payment, receipt and all. This annual accounting scheme leaves that burden up and helps you with the cash flow of the business. So to be eligible for this scheme, same conditions must be satisfied. The consequences of joining the scheme are this. Annual, right? Only one VAT return is submitted each year. But payments must still be made regularly. Normally, 9 payments on account of the VAT liability for the year are made at the end of months 4 to 12 in that year. Remember these dates. And under which scheme it falls, you have to remember that also. So often students get confused among the schemes. Each payment represents 10% of VAT liability of the previous year or an estimated VAT liability for the year if a new business. Okay, a balancing payment or a repayment claim is made at the same time as the annual return is filed, which must be within 2 months of the end of the annual return period. All payments are made electronically. Trader may apply to HMRC to agree quarterly payments on account instead of normally 9 monthly payments. So there are 9 monthly payments. A business cannot join the annual accounting scheme if it is a member of a VAT group. You can't join an annual accounting scheme. Next, flat rate scheme, the third scheme. Here, if your taxable turnover excluding VAT of 150,000 or less, you can use flat rate scheme, provided no VAT offense in previous 12 months. Consequences are this. Under flat rate scheme, VAT liability due to HMRC is calculated like this. There is a flat rate percentage given to you. Multiply it with the total VAT inclusive turnover. It includes all taxable and exempt supplies. Next, flat rate scheme. No input VAT is recovered. Although you can make a claim to recover the VAT on the purchase of capital assets that cost more than 2,000. The need to calculate and record detailed output and input VAT information is removed. Here you don't have to do that. Next, the percentage varies according to the type of trade. But in your exam, they will give you the rate. Don't worry. A high flat rate of 16.5% applies to all types of business. Okay. You will not be expected to identify when to use this percentage. But it will be provided to you in a question. You don't have to know. They will give you if it's required. Okay. In the first year, in which a trader is registered for VAT, a 1% discount on the normal percentage is given. If a business incurs a considerable amount of input VAT, if you are getting, because you cannot recover input VAT, and if you are having considerable amount of input VAT, it is not beneficial to join the scheme. You should use some other scheme. Next, the flat rate scheme is only used to calculate VAT due to HMRC. In other aspect, VAT is dealt in the normal way. So there is a VAT invoice. Still you have to issue it to customer. VAT is charged 20% standard rated. VAT account must still be maintained. And the flat rate scheme can be used together with the annual accounting scheme also. You can use two schemes together. But it is not possible to join the flat rate and the cash accounting scheme together. However, it is possible to request that the flat rate scheme calculations are performed on a cash paid receipt basis. That you can do. A business cannot join the flat rate scheme if it is a member of VAT group. Same like annual accounting scheme. Flat rate also you can't join if you are a member of VAT group. Only cash accounting scheme you can join. Next. So a trader may stay in the scheme until the total VAT inclusive turnover having both taxable and exempt supply of the business in the previous 12 months exists 230. Until it exists 230,000, you can stay in the scheme. Now, summary. So let's summarize the three schemes. Cash accounting. Same conditions as annual accounting. Account on cash paid, cash receipt. Advantages, automatic irrecoverable debt relief, easier administration. Annual accounting. Same conditions as cash, only one VAT return for a year, pays electronically, 9 monthly installments of 10% or 3 quarterly installments of 25% plus balancing payment. First installment end of month 4, final payment 2 months after the year end. Advantages, regular cash outflows, easy administration. Conditions for both cash and accounting are same. Annual turnover should be less than 1.35 million, excluding VAT and capital sales. Up to date return and payment, you have to leave the scheme if your taxable turnover is more than 1.6 million. Cash account, flat rate, VAT payment should be flat rate percentage into VAT inclusive total turnover. Conditions, turnover should be less than 150,000. Advantages, no need for detailed records of sales and purchase, easy administration. You have to leave the scheme if your taxable turnover is greater than 230,000 in the previous 12 months. Now let us do a question on the scheme. Test your understanding 2. So in test your understanding 2, Vector is registered for VAT and he has been given some information. Unless stated otherwise, all of the above figures are exclusive of VAT. You have to calculate the amount of VAT payable for the quarter ended 31st March 2024. State the conditions that Vector must satisfy before it will be permitted to use cash accounting scheme and advise the company the implications of using the scheme. So now we'll calculate the VAT payable. VAT payable means output VAT and input VAT. Okay, so sales invoice, this is an output VAT totaling 128,000 and there's a trade discount of 2.5%. If there's a trade discount and it is standard rated sales, they will give you standard rated, zero rated or exempt. Remember, this VAT will be on the discounted, it's a trade discount. So you have to take 2.5% of 128, on that you have to charge the VAT, output VAT. So here when you are doing the VAT return, you have to write like this: quarter ended. First we'll list the output VAT, then we'll deduct the expenses, input VAT. So here you see you are taking 20%, 128 onto this trade discount. Done. Next, received an advance deposit. This is also an output VAT, 4,500. So the total value of the contract is 10,000. Both figures are inclusive of VAT. They have told you. You have to take the VAT out now. Okay. So here it's an advance payment. Just a minute. Advance deposit of 4,500. Total value of the contract is 10,000. Out of this 10, you have received 4,500. It's a cash accounting. So 4,500. Take the VAT out. Okay, it's this advance payment. Next, standard rated expenses. This is an expense. It will go into input VAT. 74,800. This includes entertaining UK customer. 4,200 not allowed. But 74,800, yes, you can take. So 74,800 minus 4,200. You have to take it out because this 4,200 is included in this. 4,200 is not allowed. You see here note 2. If you see note 2, input VAT on business entertainment is not recoverable because it is relating to entertaining UK customer. If you are entertaining overseas customer, it's allowed. And then you take 20%. Next, they wrote of 12,000. as an irrecoverable debt. So this is regarding 3 invoices. Okay. The debt was in respect of 3 invoices, each of 4,000. One is 15 August, one is 15 September, one is 15 October. No discounts were offered on this sales. Okay. So now what do? You get an irrecoverable debt relief. Remember, you will only get for the two 4,000s. That is 15th August and 15th September, not 15th October. Why? If you take 15th October to 31st March, November, December, January, February, March, it's 5 months. 6 months have not elapsed. So only the first 2 to 4,000s you will get the relief. There is a note to it. Relief for recoverable debt is not given until 6 months from the time the payment is due. So only it can be claimed for 15 August and September payments. Next, they purchased a car costing 9,800. They will not get a relief for it. But for the running cost, that means for petrol and all, they will get. CO2 emissions 125, quarter skill charge is 276. Both are inclusive of VAT. Both means the 9,800 and this 276. So this fuel scale charge you have to take the VAT out. It's an output VAT. So that's it. Once you get, deduct input VAT, total of input VAT from total of output VAT and get your VAT payable. This one. Okay, it's very easy. Trust me, VAT is one of the easiest one. And here, input VAT cannot be recovered in respect of car, as it is not exclusively used for the business purpose. Okay, it is used for the sales manager. They told the company purchased a car costing this for the use of sales manager. Now, so although the ACCA uses a VAT fraction of this, it is equally valid to use a VAT fraction of 1/6. They've made it very clear to you. Okay, now, so one more thing, we'll read this. Amounts due from customer normally recorded inclusive of VAT. However, question clearly states that all figures are VAT exclusive unless stated otherwise. Hence, the two invoices of 4,000 due from customer and written off as a recorded days are treated as VAT exclusive. Okay. Coming to part B. Conditions for cash accounting scheme. So this is just simply theory that you can write. That is, it should not exceed 1.35 million. Must be up to date. Okay. So the scheme will result in tax payment become the date of payment received from customer. Automatic irrecoverable debt relief is there. And recovery of input VAT is delayed until payment is made. All what you have covered in the slide. It's the same thing. The third part in this lecture is new for ATX, which is on land and buildings. So supplies of land and buildings in UK can be 0 rated, standard rated or exempt. If it is 0 rated, okay, freehold sales or leases of more than 21 years are 0 rated. Of residential and charitable building. Remember, building has to be residential and charitable, more than 21 years, either freehold or leases. Could be any type of building. Next, standard rated. When you're selling a new freehold commercial building less than 3 years from their construction, it's standard rated, and after this, all other supplies of land and buildings are exempt unless that exemption is waived. Now, opting to tax. You can opt to tax. So, a VAT registered vendor or a lessor, if you're leasing, that's why you're known as lessor, of a building, can opt to waive the exemption of a building. That means they are opting to tax. So the conditions are, election must be filed within 30 days of signing. This can be withdrawn with the initial 6 months cooling off period or after 20 years. Either within 6 months or after 20 years. Otherwise irrevocable. Election cannot be made for a part of a building. Although election can be made separately for each property owned. If you are making for one building, it applies to whole building. Whole building will be taxed. Next, impact of this election. Supply then becomes taxable supply. You can recover the input tax of the building. Future supply of the building. That means all your sales and your rent that you are receiving then must be standard rated. And the new owners. Good thing is the new owners of that building are not bound by a previous owner's election except for the transfers within a VAT group. If you are transferring the building within the VAT group, once the election is made, it applies to the other member also. But if it's to an outside party that you are selling the building, new owner can choose to elect again if they want to. Okay, otherwise it will be exempt. Next, note that opting to tax is particularly useful for landlords letting out commercial property, which would normally be an exempt supply. Why? Because you can recover input tax. Main advantage, you can recover input tax on the purchase and the running cost of the building. Tenants who are fully taxable trader, they also can recover any VAT charge on them for their rent. If tenants are exempt or partially exempt, then there is a disadvantage if the landlord makes this election, because then the tenant cannot recover all the VAT that is charged on them for their rent, the rent that they are paying. So such traders would prefer to have a tenancy in a building with no option to tax. So you have to know when to tax and when not to tax, advantages and disadvantages. Now when you're transferring the building as a going concern and you are making an option to tax, so the building can only be included as a part of a transfer of a going concern if the new owner also opts to tax the building. See, you are saying you are transferring this business as a part of a going concern. This can only be made if the new owner also elects to tax the building. Therefore, you are avoiding VAT. Okay. So when the old owner is transferring this to the new owner, VAT is avoided on the old owner, the one who is selling the building. He does not have to pay VAT if the new owner also opts to tax the building. So if the new owner does not make the election, VAT must be charged by the vendor on the sale of the building. Then the old owner has to pay the VAT. Now, because it's land, with the land comes stamp duty land tax. So this is charged on purchaser of the building, on the consideration of the building including VAT, even if the purchaser can recover the VAT as input tax. Now, partial exemption. Before we move on to partial exemption, let us do question on land and buildings. Illustration 2. Now you have to state whether the statements are true or false. First statement, waiver of exemption is the same thing as opting to tax. It's true. Second, once made, the waiver of exemption can never be revoked. This is false. Why? Because you can withdraw the waiver within 6 months or after 20 years. Otherwise, it's irrevocable. Third, if you buy a building which the previous owner has opted to tax, you are obliged to continue the option. Third, once again, is false. Why? Remember, the only time this is true is when the sales takes place within a VAT group. Fourth, sale of the second-hand commercial building is always an exempt supply. False. Why? Because the owner have opted to tax the building or it may be less than 3 years old. Okay. Fifth, supply of new freehold building is always a standard rated supply. This is also false. Why? Because the building could be residential or charitable use, right? The building could be for residential or charitable use. In that case, sale will be 0 rated. Obviously, you will not get question on ATX on this true or false, right? It is just to make your understanding better. That what you have studied till now, you are understanding and are able to apply. Now, test understanding 3. State the VAT implications of the above 3 transactions. Assuming X, Y, Z are all registered traders and all transactions takes place within UK. So, first one is X, second one is Y, third one is Z. Okay. X is purchasing a new factory building for use in his manufacturing trading for building, paying 700,000. So tell me. So this one will be at standard rated. Okay. It's a new commercial building. Therefore, it is standard rated. And it is assumed it's VAT inclusive price. Otherwise, they would write VAT exclusive. You should always assume it's VAT inclusive, because we always pay with the VAT. So this 700 includes VAT in it. So take the VAT out of the 700. This is the VAT. Okay. This you can reclaim because you're standard rated. You can reclaim this. Next, Y. Granting a 25-year lease on the office block which is intended for use in the Y's trade. Once again, it is unless the landlord has opted to tax the transaction, this will be an exempt supply. Y PLC will not incur any input tax. Why? Greater than 21. It's greater than 21. It's 25. Therefore, it is an exempt supply unless you elect to opt the tax. Therefore, they will not incur any input tax. Coming to Z, sells a 15-year-old freehold building. Again, it is. So normally, the sale of a building at least 3 years old will be an exempt supply and no VAT will be charged. However, if they opted to tax the building, they will have to charge VAT on the disposal. Okay. The fourth subtopic, this is also new and this has a very high chance of occurring in ATX. That is partial exemption. So make sure that you know this part very well. One area might be asked on this part. Okay. Here, partial exemption is where traders who make both taxable and exempt supplies. So they are given credit only for the part of input tax that they incur. So this section deals with the calculation of recoverable input tax credit. This is a technical area, a lot of technical areas you will learn. Okay. Now, how do you recover the input tax? Input tax is analyzed into three categories. Please understand. First, when you are making wholly taxable supply. Okay. So you will get the whole credit for whatever input tax you have incurred. If it's 100% taxable supply, you will get the whole input tax back. Next, totally exempt supply. Wholly disallowed. You will not recover any input tax. And if you are making a mixture of taxable supply. So here, the third area is the one which is we have to work. Here you will get some credit. It is by apportionment. The one which is for taxable supply, you will get the relief. The one for exempt supply, it's disallowed. Okay. So this is the remainder. It is that where you cannot attribute the input tax either to the taxable or exempt. Okay. Now, so the non-attributable input tax available for credit is the taxable portion of total supply found by using a fraction. Remember this fraction. Total taxable supply divided by total supply. It excludes VAT and it excludes supply of capital goods, because capital good we are going to come in the next section, the last section of this lecture, fifth section. There we are going to cover different method of dealing with supplying of capital goods. Okay. So when you are calculating this fraction, exclude the VAT and exclude the supply of capital goods. So this ratio will be a percentage. Okay. It is not a whole number. If it's not a whole number. If it's not a whole number, it is rounded up to the next whole number. You need a percentage for it. Now, so the percentage used during the year is generally the annual percentage from the previous year. Alternatively, business can choose to calculate the percentage each quarter based on supplies for that quarter. Whichever method you use, you have to use consistently throughout the year. In either case, you have to make an annual adjustment at the end of accounting period. Any reasonable method of apportionment can be agreed with HMRC. Where a VAT group is there, Okay, where a VAT group is present, the process must be completed using group figures. Annual adjustment. So the amount of recoverable input VAT is initially calculated for each VAT return period separately. Usually for each quarter return based on the supplies of previous year or the actual supply for the quarter, or all of its initially recoverable if the annual test is satisfied. However, you have to make an annual adjustment calculation at the end of accounting period. Any under or over declaration is then accounted to HMRC or reclaimed from them on the first VAT return of the next year. If the business is opting to bring forward the annual adjustment calculation to the last VAT return of the year, okay, they can do that. Business can opt for it. For example, if there was a repayment due from the first VAT return, they can bring the annual adjustment calculation to the last VAT return of the year. De minimis limit, this is where you are going to be tested, the calculation part. All input tax, including that relating wholly or partly to exempt supplies, may be recovered if the business is below the de minimis limit. There are 3 tests to see whether the business is de minimis. Simplified test 1, simplified test 2, and the de minimis limit. So simplified test 1, you have to remember this figure and you have to remember the test. Total input tax is less or equal to 625 per month. That's why I've highlighted per month. Don't take just 625. Sometimes they might give you 625 annually. Sometimes they might give you 625 quarterly. But you have to take per month on average. And the value of the exempt supply should be less than or equal to 50% of the value of total supply. Simplified test 2. Total input tax less input tax directly attributable to taxable supply should be less than 625 per month, and value of exempt supply less than 50 of total supply. Normal de minimis rule, test 3. Your total irrecoverable input tax, that means input tax relating to exempt supply, should be less than 625 per month and less than 50% of total input VAT. You need this. This is very important. Calculations will be asked on this. Now the de minimis limit. The business only needs to satisfy one test. Simplified tests were introduced to save some businesses the need to carry out a full partial exemption calculation to confirm their de minimis status. Now, the annual test. Business can apply this de minimis test once a year rather than every return period if the business was de minimis in the previous year and annual test is applied consistently throughout the current year and the input VAT for the current year is not expected to exceed 1 million. This means that business can recover all input VAT relating to exempt supply in each return period without having to perform de minimis calculation. At the end of the accounting period, the de minimis status must be reviewed based on the year as a whole and an annual adjustments made if necessary. Now let us do questions on this area. Illustration 3. So we are going to go through 4 questions. This is relating to partial exemption. You have some activity and attributable input tax is given at standard rated, zero rated, exam rated, and overheads and total input tax. So you have to calculate the recoverable input tax, the input tax that you can recover for the quarter ended 30th June 2023, assuming they choose to calculate the percentage based of supplies for the quarter. Okay, now, so first we'll do the test. Okay, simplified test 1. We'll do both the simplified test and see whether it fails or not before we move on to the de minimis test. So test number 1. You have to see whether it is exiting 625 per quarter. Okay, so you have been given here what is the total input tax? 23,000. This is quarter. Relevant figures for the quarter ended 30th June. So here, how many supplies you are making? 3 supplies. Standard rate is 0 rate, exempt rate, and on average. So because of on average, this 23,000 you have to divide by 3. And this is your total monthly input tax. Okay, per month, because in a quarter there are 3 months. So if you want to find per quarter, you have to divide by 3. Quarterly figure you have to change it to monthly, because we want the monthly. So total monthly input tax is this. This is also monthly. That's why you have to see whether it is exiting this. So it is exiting. So because it is exiting, it is not satisfied. Remember, it should not exit for you to recover input tax, but it is exiting. Test 2. From your total input tax minus the tax directly attributable to taxable supply. So this is your total tax attributable to taxable supply. There are 2 taxable supply, this and this. 0 rate or standard rate. 10,500 plus 3,000 minus 3,500. So you do it and divide the answer by 3. This is also not less than 625. Simplified test 2 is also not satisfied. Therefore, you have to make a full calculation. Both simplified tests are failed. Now, we'll do the de minimis. When you do the de minimis test, you have to do a column or format like this. Listing your taxable supply and exempt supply. In taxable supply, both 0 rated and standard rated are taken together. Okay. So you are adding this is input VAT, 10,500 and 3,500. And for exempt, it is 4,000. And how much is for overhead? There is a working required. It's given 5,000, but you have to find it, because you have to find the portion for taxable supply, the overhead, and for exempt. That's why I have to do a working. We know the total is 5,000. But how much out of the overhead is for taxable and how much input tax is for exempt, that we don't know. There is a working for it. Okay. So we'll go to the working. You need this percentage. This is the working. Okay. So you have to find total taxable supply over total. You need this figure. 96 and 32, and total will be this, and taxable will be only this too. You have to add 96 and 32. So therefore, you see 96 and 32 over the total into 100. It is 78%. It is rounded to the whole percentage. Maybe it was 77 point something, so 78. This is 78, so 78% of 5,000, 3,900 and 1,100. Now, so that 3,900 is for this, is for taxable supply. This percentage 78 is for taxable supply, not exempt. The balance is exempt. Now you see, so you have got it. Because you need this. So once you have got it, now we'll see. So the monthly input tax relating to exempt supply is how much? You need this total. That's why. For de minimis test, you need the total of exempt supply. You need the total input tax of exempt supply. That's why we are doing this percentage and finding this overhead portion out to find the total. This 5,100 we need. This is what we need for de minimis test. That's why we are doing all this table. So it's 5,100. This is quarter. It's quarter. You need to divide it for month. It's monthly. Divide by 3. So monthly input tax is 1,700. And if you see 1,700, this also exists. Exit 625. So even the test 3 is not satisfied. If all the 3 tests are not satisfied, what happens? You are not getting. See, if all the tests are not satisfied, means you are not getting the recoverable. Your input will be Input VAT will be recovered only for taxable supply, only for this. Let me highlight it. Only this 17,900. Therefore, recoverable input VAT is the taxable supply. You are not getting any portion of the, let me highlight it different color. You're not getting any portion of 5,100. Nothing of the input VAT you have incurred for exam supply you are going to recover, because you have not met any of the test. So fully for taxable supply 17,900 you are going to recover. Recoverable input VAT is 17,900. Now so that is it. Coming to annual adjustment. Okay, so at the end of the year, when you are calculating the recoverable input VAT for this quarter ended, same calculation is to be performed on an annual basis. Then you will have under or over claims for the previous quarters. If you are having any under or over claims for the previous quarters that are made in this last return period or in the first return period of the following year. Okay, now same way we'll come to illustration 4. This is the next question. Partial exemption annual adjustment. Here you have to do annual adjustment. First one was without annual adjustment. Now we are slowly coming to more difficult areas. Same way, same format you have been given. Okay, so this is from illustration 3. Continues to trade for the rest of the year. Reclaims total input VAT of this much over the year. They have given. You have to do annual adjustment later on. But normal test we can do now. We can quickly do the test. This figures that are given to you. Okay. So here calculate the annual adjustment required for the. So this are annual figure. His final results for the year. Earlier it was quarter results. See, it matters whether the results are given monthly, quarterly, annually. Because this time is given annually, you will not divide by 3. Earlier it was given quarterly. Now you will divide it by 12. You see the difference? So this total you will divide by 12. It is this. So this does it exists this. Test 1 is not satisfied. Coming to 2. So from here you deduct this 2. These are taxable supply. You deduct and you get this. This you divide by 12. This is this. It exists this. Test 2 is also not satisfied. Come to de minimis. Same way. Add both this. It is this 2. Okay, this 2 you are adding. And exempt is 17,100. Then overhead. Overhead 22,000 is given. This you have to apportion between exempt and this one. Working. Same working. Find the percentage. So go here. And when you are doing this percentage, here you need the amount, not the input tax. So you get 77. This is for taxable. This is for exempt. You put here. Okay. Now, so this you divide by 12 and you find this. This is also more than this. De minimis is not satisfied. Therefore, this is your recoverable input. But if you see in the year, you have you reclaim the total input VAT 82,500. But here it is 79,40. It's less. So find the difference. This amount is payable. Input VAT total you can recover is 7,940, but you have reclaimed more. So now you have to pay the excess amount. That's why amount payable is the difference. Okay. This is what is known as annual adjustment. That is the only difference. Okay. Now, coming to test your understanding 4. So now you have understood the nature. Now we can quickly move through this one. Here also they are making taxable, exempt, non-attributable input tax, value and the value. Taxable supply, exempt supply. Rather than table, they have given you like this. The same way. You have to do the retest. You have to calculate the deductible input tax. Assuming they use standard method of attribution. Choose to calculate the percent based on the supplies of the quarter. Calculate the annual adjustment. This is the input VAT. Okay, so the total input VAT recovery based on calculation of the 4 quarters separately is this. Now let us do test understanding 4. So just fill in the table using the table. This has been given. Do the working. We'll go straight to the formula using the values. Okay, 88%. So this is for taxable, this is for exempt. So now you have done it. Now here, so the total input VAT less input VAT directly attributed as well, if you see, are all clearly greater than 625. If you see these amounts also, okay, you can do it yourself and check. So that means both the tests are not satisfied. Okay, this is also quarter ended. So therefore none of the determined tests are satisfied. So none of the tests are satisfied. You can check the test on your own. This is the recoverable. But you have to do an annual adjustment. They have given you the figure 53,625. This time it's opposite. You can recover more, but you have reclaimed less. This time you are going to get the excess payment. Okay. So the above figures are annual figure. The apportionment would be same, but the determined test needs to be reconsidered. You have to reconsider. If the above figure were annual figure, no issue. But now you have to do an adjustment. Why? Because they are not annual figure. You need an annual figure. This 53,625 is an annual figure. So now, so total monthly input tax is 65,250. Okay, divide this by 12. Monthly input tax is this much. This exists, this test 1 not satisfied. So these are basically test 1, test 2. That's how you have got the answer. Here also, this 32 divided by 12, it's this not satisfied. And here 3, test 3. Here you are doing the annual adjustment. Okay. So from exempt it is this 7360. So this 7360 you divide by 12 and it is 613. It is meeting the de minimis test is satisfied here. So this is less than 625. And not only that, you have to find another one. The total irrecoverable VAT. 50% of the total input VAT. So if you see what is the 50% of the total input VAT, what is the total input VAT? Total input VAT is 65,250. Take 50% of it, which is 32,625. So if you see this input tax is less than this amount, 50% of the total input VAT. Input tax related to exempt supplies only. Exempt supply is this much, 7360. This 7360 is less than 50% of total input VAT. That is 32,625. Therefore, test 3 is satisfied. So because test 3 is satisfied, what happens? Just so if you are taking, see this you are taking on a 3-month period, okay? This test on 3-month period they are not satisfied on a quarterly. But when you're taking annual adjustment, test 3 is satisfied. Okay. So now, because test 3 is satisfied, this entire 65250 you can recover. So this entire can be recovered now. That is the meaning of satisfying the test 3. If test 3 is satisfied, all input VAT suffered for the year can be recovered. So now the annual adjustment, they have given this much. You can recover this much, you have reclaimed this much. This is your annual adjustment. You will get a repayment of input VAT of that much. You can claim this much, 11,6250. Okay, so you will claim to make the adjustment in the last quarter return to 31st 24 December rather than wait until the first quarter of the following year. Now, last question, test understanding 5. Here, explain whether a group VAT registration would be worthwhile. You have to do with pre-group and post-group. Okay. Now, so both, he is having 100%. Both are UK resident trading companies. Supplies for VAT purpose are taxable. All of the spreads are for only 25% of supplies of enterprise are taxable and 75% are exempt. And they have given you the amount. Okay. They have given you the input tax also. They have already given you relating to group overheads. So now, let us quickly do that. Both companies can account for VAT separately and input tax would be as follows. Okay. First, we'll find without the group. Okay. He can recover all input VAT because fully taxable. All taxable supply. What is it? How much? 65,000 for spread. Relating to taxable supply, relating to share of group overheads. Okay. Next, for enterprise, remember only 25%. There is a working one for enterprise. We'll go there. You have to do the test, 25 and 75. So here, $40,000 taxable, 15,000 exempt and 18,000. So 18,000 you have to allocate. So this 18,000 they have given. Allocate 25, 75. Already percentage is given. Allocate. And you get. So now, they have given you. So the total input VAT, if you see. What is the total input VAT? This one. $173,000. So sometimes looking at the figures you can make an estimate. Okay. Rather than calculating each time simplified test 1 and 2. Just wait a minute. I want to see the figures are given in. So this figures for the year ended. Okay. So you can divide by 12 and check if you want to see. Okay. So if you see, they are clearly all greater than 625 per month on average. Therefore, none of the denominators is satisfied. So this 44,500 would be your amount that you can recover. So you add, this is your recoverable input VAT without group. Now with group, there is a working one. Okay. So working 2, group position. What do you do with group? You add the taxable supply. You add the exempt supply. And see below for split. How they have split it. The overhead. Okay. So you have to check for it. Now, So here you have to add, see, this straight away 600 you can add taxable supply. When you're adding this straight away you can add off spread, but here when you're taking 950 you have to take 25%, only 25% are taxable, okay, of enterprise. So you are just taking 25%, and the total supply you don't have to take total will be exempt also. So this divide by this is the percentage. So 55 is taxable, 45 is exempt. That's how you get and allocate the overhead. So now if you check this figure also, de minimis test, this is also greater than 625. So none of the de minimis are satisfied. Therefore, sorry, if you see this, so this is the amount 12,650. 12,650 is what you can recover relating to group overheads. And relating to taxable supply, how much? Entire taxable amount here. This 60 and this 40. Because they are relating to taxable supplies entirely, you can claim at both. Only the group portion you have to do the working. And you add both here and you get this. So if you see here, recoverable import without VAT registration is lower. So having a group is better. It's worthwhile for them to form a VAT group as it allows a higher recovery of import VAT. 3,150 more they are getting import VAT recovered. The last part of this lecture, capital goods scheme. Capital goods scheme applies to partially exempt business that spend large sums on land and buildings or computers. Where the scheme applies, there's an initial deduction of input tax is made in the ordinary way and reviewed over a set adjustment period. This is to stop business manipulating their proportion of taxable and exempt supplies in the period of purchase in order to reclaim more input tax. So now, assets covered by the scheme. Okay, these are VAT exclusive figure. If it's land and building, 250,000 or more, and for computers 50,000 or more. Adjustment period for land and buildings is 10 and computer it's 5 year. But for land and buildings it's 5 year when it is subject to a lease of less than 10 years at acquisition. And computers is 5 years. Now, assets covered by the scheme. Let's say a trader is making 70% taxable supply and 30% exempt. So they can reclaim 70% of input VAT. Adjustments are made over the next 10 or 5 years if proportion of exempt supply changes. So the year of purchase counts as adjustment year 1. Annual adjustment is like this. Total original input tax divide by 10 or 5, multiply by the percentage now minus percentage in the original year. The adjustment is made in the second VAT return. Following the end of the VAT year, the adjustment is for. Now let us do a question. Illustration 5. Explain how Confucian can recover input VAT on purchase of a building. Okay. So here, buys a new freehold building for 5,250,000 including VAT. 40% of building is used exempt supply, tax 60 is taxable. After 7 years, this changes to 50-50. See, this happens when you are making the changes in the taxable and exempt percentage. So now, until 6 years, there is no issue. Okay. So now, this purchase of building is subject to what? Capital goods scheme. Because the building is more than 250. And adjustment period is 10 because it's a freehold. If it's a freehold, it's 10. If it's a lease, less than 10 years, it's 5 years. Now, the initial recovery of input tax. Okay. What is the purchase? 5,250,000. How much is taxable? 60. And because it's VAT inclusive, take the VAT out. This one. So, for year 1 to 7, no adjustment. But year 8, 9, 10, they have to make an adjustment. Now, This 875. So if you check here, okay, if you take the 20% of 5,250,000, it is 875,000. Okay, that 875, that's the VAT. Keep the VAT, don't find 60 and 40, it was before. You have to divide it by 10 according to the formula. And what is the new percentage? 50. What is the old percentage? 60. So now this is the method this you have to owe to HMRC. Why you have to owe to it? How do you know that you have to owe to HMRC? See, earlier you are making taxable supply 60, now you are making taxable supply 50. It has reduced by 10%. You are making less taxable supply means you will recover less input. You have to pay to HMRC, so you owe this amount to HMRC. Now, illustration 6. Calculate the input VAT relief that Delta can obtain. So he's a partial exempt trader, 30% exempt, 70% taxable. Okay, buys a freehold for 2 million, and it's a freehold. After 2 years, 40 is exempt, 60 is taxable. After further 3 years, they cease the exempt trade and makes only taxable supply from there on. Okay, 2 times they have made the changes. So this building also will fall because it's more than 250,000. It's 2 million and it's freehold, so it will be divided by 10. Okay, so this 2 million is VAT inclusive. Take the VAT out, and 70% is taxable, so 70%. So this is your initial recovery of VAT. Now, for year 1 to 2, year 3, after 2 years it changes, right? So this, after you take the VAT, you divide by 10. Earlier it was 60, now it's 70. See, sorry, now it is 60, earlier it was 70. New versus old. Okay, so then this will be the amount due to HMRC for each of the years 3, 4, 5. Why it's due? Earlier you are making 70% taxable, now you are making 60%, you are making less taxable. Okay, so for years 6 to 10, they will be able to reclaim the further input tax relief. Why now they can reclaim? Because they are making 100% taxable supply now. Entire tax, so they can reclaim. So same 2 million, take the VAT, divide by 10. Now they are making 100% taxable. Earlier it was 70. You see, this 70 will remain fixed. It is the original 70, not from 60. It is not from 60 you have to take. From the first one, originally 70. This will remain 70 only. Only this will keep changing, the first number. So then it will be 10,000 for 6, 7, 8, 9, 10. This you can reclaim in year 6, 7, 8, 9, 10. Adjustments for sell when you're selling the building. So when you're selling, you have to make an adjustment. Annual adjustment is made as normal in the year of disposal, as if the asset has been used for the full year. Now, a further adjustment must be made to cover the remaining intervals. Adjustment for sale is as follows. If the disposal was taxable, okay, example, you're optioning to tax, okay, option to tax exists or the building is less than 3 years old. We assume 100% taxable use for the remainder of the adjustment period. Although, note that the VAT recovery cannot exceed the VAT charged on the sale of the asset. If the disposal was exempt, let's say no option to tax exists, we assume 0% taxable use for the remainder of the adjustment period. The adjustment for sale is made in the second VAT return following the end of the interval in which the asset is sold. Let us do the final question. Illustration 7. So here, first one, from the year 6 onwards, you have to calculate adjustment. Does not opt to tax the sale, opts to tax the sale. This is from illustration 6. Okay, so they are selling the building in year 6 for 2.5 million. Remember, in year 6, in illustration it was 10,000. This they have reclaimed from HMRC. Now you have to make an adjustment for sale. Okay, so here this was 2 million. So as the building is now at least 3 years old, the sale is exempt. Therefore, an amount has to be repaid to HMRC. See, whatever you are reclaiming, now you have to pay back to HMRC. Why? Because building is exempt. As if the building have a 0% taxable use for the remaining intervals. That means for 4 years. So that means it will be 0, and initially it was 70% taxable, right? 2 million was the cost of the, this is from illustration 6, that's how we got this figure. 2 million was the cost of the building. Take the VAT, you have divided by 10. Now it is 0% taxable and 70, and for 4 years. So this much will be repaid to HMRC. Next, when you opt into tax, still 10,000. Okay, so 100% taxable. So 100 minus 70, only this changes. Everything else remains the same. This will be now reclaimed from HMRC. That is the only difference. So let's summarize this lecture. We started VAT, revision, scope of VAT, types of supply, zero rated and exempt, registration, VAT groups, deregistration, sale of business, special small business schemes, the cash flat rate and annual. New areas are land and buildings, option to tax, types of supply, partial exemption and capital goods scheme. That's it for this lecture. So now I shall see you in the next lecture, that is the continuation of VAT, focusing on the administration part of VAT and the overseas aspect of VAT. And now it's your job to do the questions on VAT, and please follow through my previous lectures if you have missed out. You can watch it under the ATX playlist, and you can also buy these slides from me. All you have to do is email me at my Gmail, accsarbi@gmail.com. Thank you.